You know, the financial markets are always talking to us. Most of the time, it's just a whisper, but every now and then, they absolutely shout. And today, we're going to decode one of those shouts, a real-world, massive bet on Amazon. We're going to break this thing down piece by piece to really see how the pros operate and figure out what we can learn from them. $105 million. Okay, let's just let that number sink in for a second. This isn't just some random figure. It's a huge signal from what traders like to call the smart money. And in this explainer, we're going to be detectives. We're going to decode that signal together. So what is this signal exactly? Well, it's not just some simple bet that Amazon stock is going to go up. No. It's way more clever than that. It's a strategy that shows this deep, deep understanding of a company's value, of timing, of risk. Honestly, it's like a masterclass in how to think about investing, and there's a ton we can all learn from it. Okay, so here's the nitty-gritty. Some big player out there, probably an institution, sold 5,000 put option contracts on Amazon. So that's the what, but that's the boring part. Now we get to dive into the really interesting stuff, the how and the why. Probably the easiest way to wrap your head around this whole thing is with this powerful analogy. See, the seller wasn't really just gambling on Amazon's stock price. No, they were acting more like an insurance company. They were literally getting paid to sell insurance on one of the biggest, most dominant companies on the planet. So the fancy Wall Street term for this is a short put. But don't let the jargon scare you. The idea is actually pretty simple. The seller gets a big chunk of cash right now, today. And in exchange, they make a promise. The promise is, hey, if Amazon stock falls below a certain price by a certain date, I promise to buy the shares at that price. Think about that. They're getting paid for making a promise to buy a fantastic company if it goes on sale. Okay, but check out the details here, because this is where it gets really smart. The official price, the strike price, is $210. But since they collected about $5 a share in cash up front, their actual break-even price is $205. This creates what's called a downside buffer. In this case, almost 12%. It's this beautiful safety cushion. They're basically screaming, we would absolutely love to own Amazon, but we're only buying it at an 11% discount. And oh yeah, you're going to pay us for the privilege of waiting. And this is the beautiful part, right? The trade is designed so that the seller is pretty happy with either outcome. I mean, think about it. If Amazon stock just hangs out above $210, great. They just pocket all that cash they collected. Pure profit. And if the stock does fall, well, then they're forced to buy, but they get to own a world-class company at the exact discount price they wanted all along. It's a win-win, strategically speaking. And this chart, it just nails the point home. Imagine Amazon's stock goes absolutely nowhere for the next year and a half, just totally flat. Well, if you just own the stock, you've made zero, nothing. But this put seller, by collecting that premium, they've manufactured their own return, a 6.4% annualized return, to be exact. They are literally getting paid to wait. All right, so this begs the huge question, right? Why $210? Why that number? What is so special about that specific price level that some institution is willing to put over $100 million on the line to defend it? Well, the answer isn't in some chart pattern. It's in the bedrock fundamentals of Amazon itself. Part one of the answer is this monster number right here, $200 billion. That is the size of the Amazon Web Services backlog. We're talking about revenue that is already contractually committed. It's a mountain of predictable, locked-in cash flow that basically acts as a giant anchor for the company's entire valuation. And this quote from the original analysis just says it all, really. The logic is, for Amazon's stock price to fall way, way below that $210 level, the value of that massive cash-gushing AWS business alone pretty much supports the price. For it to fall further, the market would have to say that Amazon's entire global e-commerce and logistics business is worth nothing, zero, which, given its scale, is just absurd. It's not a rational. And look, you can actually back this up with some pretty conservative math. When analysts do what's called a sum of the parts valuation, where you value each piece of Amazon's empire separately, AWS, advertising, retail, and then you add it all up, you land at a share price somewhere in the neighborhood of $190 to $200. This makes that $205 break-even price look incredibly safe, incredibly well defended. They're basically saying, we'll buy the whole company at what its individual parts are actually worth. Okay, if you thought that was clever, wait till you see this. Because the timing of this trade, honestly, it's genius. That expiration date, March 2026, was absolutely not chosen at random. It was picked with surgical precision to sidestep a massive looming risk. Just look at this calendar. The trade is specifically designed to be completely over, done, finished in March of 2026. Now, why does that matter? Because that is a full 6 months before the huge FTC antitrust trial against Amazon is set to kick off. This trader gets to collect all their premium during a time of relative quiet, maybe even get a boost from some good news on Project Cooper, and then they are out the door before all the chaos and uncertainty of a massive legal battle begins. It is an absolutely brilliant strategic move. So when you pull it all back, what's the big lesson here? What's the takeaway? This trade, this whole thing, it offers us a really powerful, totally new way of thinking about investing. It's a fundamental shift in perspective from trying to just guess the future to instead strategically underwriting risk. And this right here, this is the key difference in mindset. Most retail investors, we're taught to try and guess which way the stock is going to go. And we're taught to be terrified of volatility, of choppy markets. But this institutional seller, they have a completely different goal. Their goal is to underwrite a very specific, very calculated risk. And they see that market fear, that volatility, not as a threat, but as a resource, something that can be packaged up and sold for income. So let's just quickly recap the whole game plan. This trade is built on 4 really strong pillars. You've got fundamental safety from AWS. You've got a superior yield that crushes just holding cash. You have a defensive structure with that big buffer. And you have absolutely brilliant timing that dodges a huge risk. But the big idea, the simplest way to put it all, is right there at the bottom. Get paid a premium to agree to buy a great company at a discount. And that really leaves us with one final kind of mind-bending question. This whole $100 million trade is built on an idea that completely challenges how most of us are taught to view the markets. So I'll leave you with this. What if all that market choppiness, all that turbulence that we're told to fear, what if it isn't actually a threat? What if it's an asset that you can sell?